Welcome back, everyone, to this episode of the European VC podcast. Today, I'm joined by Mike McGraw from Inovia. Inovia is a 450 million leading fund out of Canada, very much kicking it now in Europe. They've been here for a while. They're actually quite incredible. They've got 2.3 billion under management, so definitely a player to be reckoned with. Today, we're talking all about European LPs and why a higher risk appetite could pay for itself if you ask Mike McGraw. We talked to him about this because he used to be an LP at CDPQ, one of the world's largest pension funds, of course, coming out of Canada. I really hope you'll enjoy this episode as much as I did making it.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.
This show is not investment advice, and the hosts of this episode may be invested in the funds and companies featured.
Mike or Michael, Mr. McGraw, what do you prefer being spoken to as?
Mike. It used to be Michael because I'm actually French Canadian, but Mike works well.
Beautiful. We'll go with Mike. Mike,
Perfect.
Let me just read out your bio for the audience to know who you are, and then you can add a bit of context to that. You're a principal at the growth equity firm Inovia Capital, 415 million euro fund size with 2.3 billion euros in total AUM. You're headquartered in Canada, but you are in the UK, London. Your target stage is Series B to pre-IPO. You're targeting the North America and Europe, and you're focusing on anything software, so you're a generalist. And you've done some notable investments that many of us know, which is Cohere, Lightspeed, Booksy, Neo4j, Hopper, Wealthsimple. Did I get that somewhat correct?
Yeah, pretty close. I mean, maybe the main color to add is I'm focused specifically on our growth strategy. That being said, the firm itself is full stack, so pre-seed to pre-IPO. $50,000 on after a good dinner, and we like what you're doing, we'll do that. And then 50 million if you're about to go public, and we can help with this because we have a bunch of operators and whatnot. But me specifically, what you're getting today is the growth angle.
Beautiful. And you're in the UK. Maybe you could share a bit about the kind of setup, because you're headquartered in Canada and comes out of the North Americas, but you're also very much focused in Europe, and you're of course spearheading that here. Could you tell us a bit about the setup, how that works?
Yeah. So I joined a bit about 6.5 years ago now. And basically what happened is within 2 months, I was moving to the UK. And for us, the strategy was to say the firm is primarily North America, but I think we saw an opportunity both in terms of the market, but also the value that we can add to help European companies come into the US. And so that's something that is more of a boutique approach, if you will, for Inovia. So we only do 1 or 2 growth deals a year. And quite often it's going to be businesses that are looking into North America. And it's something that we can help them execute on, be it talent, M&A, going public, whatever they're looking to do.
Yeah, very cool. And just one question, because I said notable investments, and in there was Lightspeed.
Yeah.
Lightspeed is, there might be a startup out there called Lightspeed. I'm sure there is, but there's also a venture firm called Lightspeed.
I mean, that's the usual problem of venture in general, right? Like we even have that internally. It's like, oh, that company. Do you mean that one or that one, right? Like the names tend to look a lot like one another. Our Lightspeed is actually one of our good successes to date. It's now a publicly traded business on the New York Stock Exchange and TSX in Canada. So it's a POS for SMB. So basically, think like a ERP to run your restaurant or your small retail operation.
That clears up some stuff. And the reason why I asked specifically if it was the firm as well was because you've also been an LP at CDPQ, which we're going to talk about.
Yeah.
And let's dive into that conversation, because you very much have the strong opinion that European LPs could actually get a lot out of having a higher risk appetite. And this, of course, comes from you having some hard-won experiences as an LP at CDPQ, which is one of the world's largest pension funds. So, and then of course, also adding to that, also your Inovia experience. So maybe I'll just pass it to you and let you tell us a bit about this perspective, why you think that European LPs could maybe stand to earn quite a bit from having a higher risk appetite.
Yeah, no, happy to discuss it. I think before even jumping on what I've seen in Europe, it's worth spending a bit of time about talking about the Canadian ecosystem, right? So when I worked at CDPQ, I was based out of Montreal, and our mandate was a mandate, obviously, for returns, right? CDPQ manages the pension for a lot of the employees of the Canadian government and the Quebec government and the population. And so there was a mix of returns and then a mix of investments, really just for to grow kind of the ecosystem in and of itself. What's interesting, I think, to know about Canada is that I kind of jokingly refer to it sometimes as the Europe of North America, right? So
Yeah.
we do have quite a few similarities in terms of not only, I think, structural similarities, right? We have top universities, we have active government support into the ecosystem, we have great social benefits, but also just in terms of values, right?
Yeah, the US puns on Canada could very often be interchanged with Europe.
Exactly, very much so. And for whatever reason, the U.S. decided to claim the title of America, right? Even though
Yeah.
there's a few more of us out there. So I like to say that we're kind of an extension, if you will, of Europe. And then we do have obviously quite a few benefits of being that close to the U.S. But I think that, again, just to contextualize from a VC perspective, Canada is, you can think about it, the size is maybe like France, Germany, Sweden. So it's like in the, $5 to $7 billion in terms of capital invested in any given year that's not COVID. And it's also felt the same type of acceleration, right? So if you think about the maturity of an ecosystem, like the venture stage kind of took off maybe 10, 15 years ago. And then last 5 to 7 years, we've really seen kind of the growth ecosystem taking off. And then last maybe 3 to 4 years, we've seen all these kind of mafias emerge, right? So the same way we have the Revolut mafia in Europe, Canada has the Shopify mafia, and that kind of does a mix of angel investments. They start new businesses, and you really see these flywheels come into motion. And so I've been privy to both kind of the Canadian evolution, and I've been part of it actually at CDPQ. And then I've seen kind of the same things play out here in Europe. And I think there's really interesting parallels to be drawn between both ecosystems.
To make sure we set the context, because now you set the geographical context, so to say, and the market context, but also a bit about yourself when you were at CDPQ. What was your role? How does CDPQ invest? How much in Europe? How much in the US? Kind of,
Yeah.
so people understand that the backdrop.
Yeah. So CDPQ, I joined to start what was called a funds and technology team. And so basically the firm, I think, was about, give or take, 200 billion under management in euros, right? So like quite massive. And they were already doing a little bit of technology, but back then it was just starting to take off. So there was a little bit of a foresight, if you will, of saying we should focus that within a specific dedicated team, right? It shouldn't just kind of fall between the cracks. And when I say technology, I mean private assets, right? Because obviously there was some in the public and everything. But the thought was to say, okay, we have a lot of assets. How do we actually put that to work effectively? And so, like a lot of other institutions, what they decided to do was you had a strategy for the mega funds, which is, kind of a good way quite often to like track the index of tech and just kind of have some of these returns. But also they wanted to find specific managers that they could back and really double down on kind of co-investment, right? So you put, and I'm just making up numbers here, right? But you put 10 to 30 to 50 million into a fund, and then you deploy hundreds of millions in the companies that are really taking off within that fund in the form of co-investments. And so that was part of the strategy. What's interesting, I think, about CDPQ in that context is that when you start with a $10 million investment, right? Like, does that really make sense? Does that really scale for a $200 billion institution? I think the intuition would be to say no. But my, observation being at CDPQ is there's a few things. As one, the 10 million pays for itself, right? If you put together a team and whatnot, like the 10 million, the returns that you'll make on that will more than justify it. So it's more about, do we want to go through the operational complexity as a large institution? And I'm sure a lot of people that, are listening would be at some of these large institutions in terms of LPs and whatnot. And what's important about these is what we saw was you make that 10 million commitment, but then that's how you unlock really the big co-investments further down the road, right? That's what CDPQ did by being an LP in Inovia, for example, and then getting to lead some of our co-investments in Lightspeed that I just mentioned that then went public. That was an amazing investment, but it initially required that relationship that they built with us as a firm. And then the last thing, which is, it's more specific to CDPQ, and it has a bit of I guess like a state mandate, if you will, is that, as I said earlier, CDPQ's inflows come from the pension of the population, the employees of the government, and everything. And so ultimately, if you make investments in the local ecosystem, and you need to think decades ahead, right? But if you do make investments in the local ecosystem and you create more Shopify's, you create more Cohere, you create more massive businesses, then you help the economy, and you're going to help ultimately the people that pay into your pension, decades down the road. Because at Inovia, we always say we want to create the next 50,000 high-paying jobs, and that's part of ultimately would benefit all of our LPs that are getting pension from these jobs at the end of the day, right?
So, in other words, here you're very much saying or describing to us how at CDPQ you were able to kind of fix the conundrum, so to say, of how can a big LP engage with smaller funds,
Yeah.
even though it's kind of from the outgo or outset considered non-sustainable or not worth the hassle. Could you tell us a bit more about the perspective, so to say, inside CDPQ in terms of this strategy? What do you think, enabled you or the CDPQ management team to make this decision? Was it these three points that you just called out, or was it something else that, allowed the environment inside CDPQ to allow you to do this?
Yeah, it's a great question. I think ultimately scale matters, right? And so if you're CDPQ and you're 200 billion under management, and again, I'm speaking for myself here. I wasn't in the
Yeah.
CEO's office making that decision, right? But it is quite easy to say, okay, we'll create an envelope of 500 million to go and do this and test it out, right? And let's set it over 5 to 10 years or something like that. And then you kind of assess the success of that strategy. But from a risk return perspective, given the skill that you have, you can have a massive impact with very little of your AUM under management. And I think, we'll talk a bit more about Europe. I think that's a big struggle for Europe is scale. Is you have, I was just looking at the stats, like in Canada, we have what we call the Maple 8, which are the kind of 8 largest pension funds in Canada. And they're quite centralized. And so they manage 1.3 billion altogether. So you average out at like 160 billion euros per pension fund, right? So this is quite big.
1.3 trillion.
Yeah, so 1.3 trillion for all 8 of them, and so 160 billion kind of each of them. And then you compare that to the UK, where I think I was looking again at statistics. It's 86 local pension schemes, and the average is 4 billion for each of them. And so if you want to have a big impact, right, it's a lot harder because you don't have a lot of room for maneuver to say, we'll invest 0.01% of our AUM in this kind of long-term strategy, and we'll revisit in 5 years to see if that works. You can't move the needle.
Long-term and individual expertise and manpower heavy.
Yeah.
Which
Exactly.
I guess, do you think that that's also because if we look at the pension ecosystems, the pension fund ecosystem, so to say, that are a bit further along in terms of allocating to venture, I think the countries that I hear about are the Nordics,
Yeah,
and also the Netherlands, which are basically the places where we have the largest pension funds. So I guess it might be connected to this. Do you have any reflections on? Because we started with a headline: European LPs could benefit from going this route of doing, actually setting up a program to do more smaller manages. In other words, bigger risk. Do you have any reflections on structurally how it can be done or how it can be made make sense within a pension fund that's subscale, so to say?
Yeah, that's a good question. You can't just make scale out of thin air, right? But I do think, for example, in the UK, they're talking about how do we aggregate some of these pension, and so I think there are structural initiatives that need to take place for some of the smaller pension. Part of the answer could be through funds of funds, right? So it's like, okay, we don't have the scale or the expertise to do it ourselves. Let us kind of go after this. Or a little bit of a walk before you run of starting with a few commitments. But I think the issue there is that you run the risk of kind of lack of diversification, right? And so you kind of, it would be dead on arrival, if you will, because of it. And so there is a need to think relatively strategically about how you want to do this. Definitely you need the expertise. Like, I think it's something, again, that we've seen is sometimes lacking in some of European institutions. Is just, do you do venture? No. And so there's not even anyone internally that thinks about it or wants to do it. And by the way, I think this is, a big part of the conversation about the challenges globally, but especially in Europe, is like exits, right? And that's also true for crossover investors. When you think about the investors that, will back an IPO in Europe, looking at them and seeing which ones of them actually have technology teams that are used to kind of valuing a startup, that's definitely not all of them, right? And so that, I think, is part of the hurdles, is really how do we get the right talent in the right places. But in my view, with my Canadian bias of the Maple 8, I do think it comes with skill, right? Like you need to have people that are there and kind of fully dedicated to it. And frankly, I haven't studied it, but I'd be curious to know what Sweden did so well to punch so much above its weight from a population to investment perspective.
Yeah, I actually don't know that case study, so maybe one we should do at some point. I do think that you're saying something important with the fund of funds. Obviously, I'm a venture partner with Inovia Capital, and I do fund investments myself. So I'm kind of, with the exact consideration that I think it's easier to diligence a manager than it is a company. So for that reason, don't do direct. And then what I've learned from just seeing Isomer in action is definitely a fund of fund is a different beast from a VC, in the sense that with a VC, diligencing a VC is very different from diligencing a private equity manager. And their books will look very different and so on and so forth. Whereas a fund of fund, I think it looks more like a private equity manager in that you're looking for a financially very astute investor. You're not looking for a renegade guy running around.
Which in VC might be the best thing, right? But yeah,
exactly,
definitely
and
different
very,
for fund of
very
fund.
hard to deal with for a large institutional pension fund. How do you write a ticket into that? But I do think that a fund of fund player is better equipped to deal with and speak at the level of a pension fund. So I do think that there's a big unlock there. Okay, now, Mike, tell me a bit about your observations when you're then out there in the market with Inovia and raising from European VC or LPs. What are you seeing in the private LP market of Europe?
Yeah, there's quite a few things. First of all, again, we'll kind of close on the scale point is really the distribution of where the money is. And so in Canada and even the US to a certain extent, right? Like you have a strong 80-20, right? So a lot of the capital is concentrated within, a manageable, I'll call it, number of institutions. And so for us, when we mapped out, okay, we're fundraising, who do we need to go and talk to? In the past, it's very easy to just say, okay, these are the names that we need to reach out to. Then I, moved to London, opened the European office with our partner here. And we're saying, okay, we're fundraising. Who do we talk to? And then it's just like an ocean, right? So it's the distribution. When you think about where the capital is, it's a much heavier kind of middle of the bell in terms of there's all these family offices, mid-sized institutions and whatnot. So already there, hurdle number one, just how do you figure out who you need to talk to? Do they have a VC mandate? All that kind of stuff can be quite challenging. And so different kind of, I guess, structural reality. The other part is, as I said earlier, quite a few LPs just don't do VC, right? And to me, what was like a story that was actually quite striking. So I was in Paris. I was just having a coffee with someone that is a placement agent in VC. Their marketing materials said, we do everything, infrastructure, credit, private equity. And I was like, well, do you actually do VC, right? And then she told me, oh yeah, of course, that's part of private equity. For us, it's just like, within that bucket. And I mean, technically, right, if you look at a textbook, like venture capital is private equity, it's private assets, but like it's a completely different asset class. Like, you and I and everyone that would be listening to this would know when we think about PE and the type of businesses that we invest in, the kind of like job that PE is versus the risk return or VC, those are completely different worlds. But the fact that some major actors in Europe today still don't view these two asset classes separately, to me was quite shocking. So I think there's still a lot of education and appetite, and unfortunately that take kind of successes to create that, right? And so that it takes a lot of time. And the issue is that quite often people will want to jump in when it becomes sexy and then pull out when hard times happen, right? So I think there's quite a few institutions that are notorious for coming in 21 and then now currently pulling back, which most GPs would tell their investors like it's the best time to invest. And so just that long-term commitment, which Europeans are usually known for, right? Like thinking about the world in more of a long-term mindset, has not been as present as what I've seen, at CDPQ and just in North America in general.
Yeah, and that's unfortunately the state of the market, right? And I think you're also right that it's something that just has to play out. I remember talking to another guy in the ecosystem privately, so I won't mention the name, but where he was like pulling his hair over a family office that was, coming into the fund, but he knew that their whole, venture strategy was going to be like, it's bound to fuck up because he'd seen it so many times. And that is just super frustrating that you just have to lean back. No, I can't fight this fight. I just have to let the LP run his course with that strategy. Hopefully, I'll be there to help clean up after it, so to say. But it is definitely we don't have we have too many LPs in Europe that don't have experience investing in our asset class, which then makes them make mistakes like this.
Yeah. I mean, it comes back a little bit to what we were saying earlier of like with family offices, what we can see is either they're quite professional and then they're really going to make sure they have a good approach, diversified and committed for the long term. Where the pitfalls are, I think, is if, for example, the family behind it, they're going to say, oh, Jane is launching her new fund or Joe's launching something. My brother told me about this, like go invest in that. Right. And usually that's never a recipe for success. Or again, like I said, they just, okay, now I'm reading about AI and the FD and kind of, or crypto, and it seems really hot. Like we should write a check. Right. And so it's kind of always kind of flavor of the day type of thing, as opposed to a more structural, how do we think about the market for the next 10 years and kind of commit through vintages with the right kind of managers based on what their appetite is, right?
What do you do yourself, Mike? So you've been on the LP side, so you kind of know how an LP think and where you might want to go and so on. How do you deal with an LP that you meet that then kind of shows these characteristics? Do you say, on to the next one, or do you actually try and educate and work with
Yeah.
that perspective?
I guess it depends how far they're gone. Like ultimately, it also depends. Like, do we get along, right? Like, if I like the person, then the beauty of fundraising is that you do get to meet epic people and build really good relationships. So obviously, I'll invest time in that. I'd say we're more than happy to educate. Like I say this quite often. Like, I think Inovia is at this amazing size whereby we're not too big that we just don't care and we tell people just write your check and then like I'll see you at the next fundraise and here's a PDF about us, but like you don't get any more info. We're at this size where we have enough resources to actually commit to building big relationships, and we're not too small that we just need to focus on the returns, right? We have that kind of extra buffer that allows us to go deeper within some of the relationships, which I quite like, and LPs appreciate because we really take the time to understand their needs. Like I'll give you an example. At our last fundraise for our venture fund, I was helping just because it's, we all kind of chip into the fundraising efforts. And there was another Canadian pension, a bit smaller, I think 30 billion under management. And they hadn't looked at VC from a Canadian perspective yet. And when you think about VC in Canada, that's going to sound cocky, but like Inovia is like the go-to name, right? Like we're really one of the big ones. And so for them, it was so interesting. I could have said, oh, listen, like you haven't looked at Canada, like, educate yourself and let us know if it's interesting, or here's what Inovia is. But what we did is we actually took the time to create a presentation about like VC in Canada, but not just from the, hey, the market is hot perspective that we have the 2 slides in our full deck. It was a full on like, here's the history of VC, here's how it's grown. It was like a full like 20 pager to educate them on like the Canadian opportunity itself. And it was their backyard, right? Like technically they should have known this, but for us, I think it was important. Part of it is just, we need to believe in what we're selling at the end of the day. But part of it was to say, we're willing to help you come along this journey if we see that there's a genuine desire to build a strategy around it.
I want to ask you something because Inovia is quite big. And I read a tweet that I read a couple of times over before I believed that I saw it. Gil Dibner from Rankula shared a tweet saying, what Europe has is too many, in caps lock, 400 million plus VC funds, not too few, which was obviously more, I don't know, but it coincided with the launch of Harry Stepping's latest fund of 400 million. So I don't know I don't know his motive, so I won't think about those. these conjecture on those right here on the air. But I'd love to ask you, what would be your point on that?
I guess let me make a broader point. It's really important to think about the fund size in the context of the market opportunity, right? Like at Inovia, when we raised our first growth fund, it was 410 million. We raised our second one in 2021. And at that point, right, money was free. Everyone was fundraising from anyone. And we said, you know what, we'll keep it at 450. Like we could have raised a lot more, but for us, it was actually quite important because our thesis was both us as an institution, how much we can deploy, but what the Canadian market can absorb. And because we only wanted to keep like a third of our fund in Europe, 2/3 is North America and largely Canada. We thought that if we started raising more, then it would actually lead to bad decision making, right? And that was quite important. It's something that really, I think, resonated with our LPs, was to say that the fund is the right size for the market opportunity. I think if you look at, that tweet and specifically Europe right now, I think there are a lot of really exciting opportunities that are going to arise, right? So it's not like that $400 million needs to be deployed today, right? Or this year, right? Like Harry has a fair bit of time. And so I think there's going to be the right amount of opportunities for it, and time will tell, but you need to think about it in terms of what's going to be the level of activity in 2 years, right? And so assume public markets get warmer for startups and there's more of like exit liquidity, and we're already seeing it a little bit in the secondary, right? I think the level of activity, and obviously there's everything that's happening around AI and these businesses that are now coming to the growth stage, I do think there's going to be enough opportunities to go around. And obviously the hottest one will get bid up. And right now there's maybe a bit too much capital chasing too few opportunities, but I don't know that this is going to be the status quo for the next 2 to 3 years.
Yeah, and I think also it's caveat on, so obviously only 1/3 of your fund is going to Europe, so you're not exactly in that bucket. I do also think that for me, when I saw the tweet, I thought, well, there's definitely a difference between the fund 3 and 4 and 5s that are in this size and those that are in fund 2. I think that it's difficult to deploy as an early manager this much capital wisely. That's why I think it's hard. And we do have a couple of funds that are early in their development and actually raising this large. I think that might be difficult.
It comes back to the point of what's the team you have behind it as well, right? Yeah. And like what firepower do you have to kind of put that money to work?
Yeah. And what I hear on this podcast all the time is definitely not that we have too many funds that can write large checks. So do I want to have a 400 million euro fund that primarily does seed? I think that's very hard. Do I want,
fair enough.
Do I want to back someone who does A and B? I think that's a very different question. I think we have a lot of room for good VCs that come to the growth market with a venture mindset and not a private equity mindset, because we have many crossovers. And this is something that I've been learning from diving a bit into the late stage market here in Europe. What I hear from many is that there might be ample capital in euros, but it tends not to always come from the people that you would want it to come from.
Yeah.
In the sense that we have, and maybe you can talk a bit about that because you're saying yes to it. So
yeah, no, it's funny. Like I was talking to an LP 2 weeks ago, and the way they asked us, they said, do you invest in momentum businesses or in what he called boring growth? Right. And so that boring growth was this, call it 35%, 30 to 40% grower, 5 to 15% EBITDA margin. Right. And that's kind of a safe bet, which is if the company just keeps growing within that realm and you exit at the same multiple as you entered, then, you make your IRR target that way. But that's very close to P if it's not pretty much P, right, in some ways. And so there has been a flight to safety from that perspective. I think there was a bit more risk appetite, obviously, a few years ago, but now that's changed. I do think that there is an opportunity for these businesses that, you can put 10 to 20 million in, and not everything is proven, but if it gets proven or if the thesis pans out, it's going to be a massive return. And that I think people have kind of shied away from a little bit, and it takes scale to do that, right? Like even for Inovia, we have an allocation to what we call high potential businesses. but we can only do so many of them with 400 million, $450 million fund, because ultimately you need scale to be able to diversify that risk away, right?
That's what I'm learning. That
Yeah.
we are definitely in a difficult spot in Europe when it comes to getting venture growth capital, so to say. I think in Europe we've weeded out a lot of you don't have to take VC money from someone who doesn't play the VC game anymore. In the early stages,
Yeah.
but in the growth stages, there's not a lot of that money that says, yeah, run as quick as you can. We're here. We're just backing you.
Yeah, especially in this day and age, right? Because like I think, and again, like it's always a picture in time, but then LPs are now asking about DPI and all of these things, and it's a lot harder to connect these dots for a GP that's raising and saying, okay, this is going to be a high DPI driver or something like that. And so we do need more skilled managers. And again, whether Harry's fund goes that way at some point, or kind of enables more companies to go there with the right amount of capital, and maybe they just skip that venture growth and get to a point where they're proven afterwards. I think time will tell, right?
We spoke a bit about Harry. I just want to go on the record and say I'm the biggest admirer of everything Harry has built,
Yeah.
and the access that he has with his fund or with his podcast and the whole ecosystem that he's built around that. I am sure that he will, as he has already done, go on to build incredible things. I'm sure that he will be a force to be reckoned with in European venture, and all the people that are dunking on him, I think they're making a big mistake.
I mean, listen, you don't raise 400 million if you don't have something to back it up, right? So no, I'm excited to see what he does. Definitely.
Okay, so I just want to ask you another thing, which is you're talking about the lack of commercial driven incentives for the private sector in Europe. Maybe you can add a few notes to that.
Yeah, I mean, it goes without saying that like government or public institutions, right, should have some role to play in an ecosystem, and especially in the early years, right? Even in the US, you can think about DARPA and whatnot, or in today's environment, in climate, you can think about the IRA and whatnot. And so a lot of them play quite directly in the ecosystem, right? Be it as LP positions or actually even like co-investments with some of the LPs. Again, I'm gonna preach a little bit for Canada here with my bias, is that what I think Canada did really well is we have, National Development Bank that will also do some of these LP commitments. It's quite commercial. More importantly, or just as important, what we have is we have this program called the Venture Capital Action Plan, VCAP, that started 10 years ago. And what that did is the government said, all right, we're not going to necessarily build out the infrastructure to do it ourselves. What we're going to do is we're going to commit 50 million to multiple funds of funds. So $400 million in total across different investment vehicles that are, privately managed by GPs. And then the Canadian government's money is going to be first in, last out. And so that way, what these funds of funds went on to do is they went on to see private investors. They said, listen, if you put money, it's going to be last in, first out, which means, you put your money very late, you get your money out very quickly, which from an IR perspective is phenomenal, right? So the Canadian government basically committed $400 million that way, and that helped these fund managers raise an extra 900 million on top of it. And so not only do you get a really good multiplicator effect on your capital, what you get is you also get these private managers that are then a lot more efficient from a bureaucratic perspective, right? I think sometimes some of the issues with public institutions, and rightly so, because they have a lot of governance and it needs to be done properly, it can take a bit of time to get them to act. But in this case, what's fantastic is you have kind of, I'll call it like the bureaucratic pain upfront of the government putting that program together and making the funds of funds commitments. But then after that, it's purely kind of commercially driven by private managers. And it's something that's been hugely successful. It was kind of renewed for a second program, and it's an ongoing structure that I think Europe should probably try to emulate if it can in one way, shape, or form.
I absolutely agree. And it's so paradoxical to see EIF, and I love EIF. They're doing so much, but fuck, could you please start having a fund of fund program? We need to get more fund of funds that can make wise choices, that can, we not a single fund of fund in Europe are not fundraising all the time. Like,
yeah, It's challenging. I think exactly like backing these managers, right? Because as you said, like Isomer is going to have like this very deep expertise, but also like being able to move quickly and whatnot. There's something quite powerful there, and you don't want to be the only LP. But if you just think about these little, the way I think about it is with the government capital being first in, last out, that's almost just like an opportunity cost, right? Like it reduces the government's IR a little bit, but it's just the right amount of risk premium for then these private investors to come in and kind of underwrite the higher risk of backing kind of Canadian ecosystem managers. And the funds of funds are not Canada only, but they have a Canadian allocation, definitely. And so I think that those kind of programs just create a lot more of a dynamic ecosystem.
I spoke to a fund manager the other day who said he has multiple fund of funds, European fund of funds in his LP base, and he said, Andreas, Isomer were the only fund of fund that came through and finally ended up investing what they had committed. The
Nice.
rest, yeah.
Yeah.
And I was like, wow. And
Yeah.
I think, like, I know these guys, they're great people. They're all hustling and doing everything they can, but it's, the fact is that it's very difficult to raise a fund of fund in Europe. And and then we end up in these situations, which is super bad for
And
you.
I mean, effectively, what you see happening is these US institutions that then have the funds of funds, right? And they'll have some European allocation. But again, I think it's a shame to not have more isomers and like across stages, right? That can really like an easy go to. And they can be, as we were saying at the beginning of the podcast, they can be an amazing way for family offices or whichever institution doesn't have a VC strategy to kind of get started within that world.
To be fair, I should add that Isomer did come in with the full amount, but it did take longer than first expected. So I don't want to leave out part of the story because I'm a venture partner and make it sound like they were incredible. They're all hustling. We're all doing our best. In the end,
Yeah, I think it's as long as it's not, like a 2-year process,
yeah.
or even like a year, right? Like these things can be quite long. As long as you're able to move relatively quickly, plus or minus a few weeks won't break the bank,
But this is any fundraiser knows, you really need to hurt your LPs because otherwise it's
Yeah. It's an art it's a science and an art in terms of, even just if you think about like building the top of funnel and like converting conversations and everything, you almost want to be scientific about how you go about it. But ultimately, like the art of the selling and the closing, yeah, it's pretty meticulous one.
Okay, so now let's pick up the pace a bit because we have stayed on this topic for quite some time, but it's rare that we have someone on the podcast that has seen both the LP side and the VC side. So and at the same time also the North American side and the European. So this was a very interesting perspective to bring. So I wanted to stay there a bit, but you're other than that. So let's hear a bit about Mike. Who is Mike McGraw? What has shaped you? How are you thinking about life?
So Mike is a former simile entrepreneur in the sense that I come from a family of entrepreneurs, and I've seen both extremes. So my mom has had her magazine that she's been publishing for almost 25 years now, and it's like slow and steady. She has an employee and a half, and it kind of pays for the bills, and is this great magazine about well-being in Quebec. And my dad was on the other end of the spectrum, scaled a graph database business 15 years ago, which ultimately didn't work out. And what it means, though, is it means that I've really kind of lived, not directly because they're my parents, so they're the one with a lot of responsibilities, right? But I've seen what it is to be an entrepreneur. I've seen the impact on the family. I've helped them on a bunch of projects and whatnot. And the funny story on this is that, while my father's business didn't work out in graph database because he was a bit too early, the other person that started a graph database around 15 years ago was Emil at Neo4j. And then Inovia ended up investing a lot of money in the business 12 years after my dad's business didn't work. So it was full circle. But no, I think I'm basically, coming from this entrepreneurial world, but now kind of supporting other entrepreneurs and the families that are associated with it, being a venture capitalist.
Yeah, and having seen your dad's journey, also know you want a portfolio.
Yeah, that's exactly. I adore the diversification of being an investor. That's probably, that experience as a family probably lowered my risk tolerance a little bit, unfortunately. But I still just couldn't get away. Like I started my career in private equity, and I was just very bored. I love the people I was working with, but I was investing in, like $300 million check. And so you basically put it and you hope that they manage it well. And you kind of are so far from the business compared to how closely we work with our entrepreneurs here at Inovia. And so I love to feel the excitement of it, but I appreciate having a more diversified portfolio, to your point.
Yeah, I think that's wise. You have two sayings that mean a lot to you. I just want to preface it with, because you're saying that it's very Canadian of you, but I also think that those two statements are also a good explainer of why you're in venture. So let's get your two statements.
Yeah, I guess the context to it also. So the partner here at Inovia in London is the former CFO at Google. His name is Patrick, and he's just this, again, I'm biased, right? But like amazing human being, comes from, rag to riches. He was born in the poorest neighborhood in Montreal and kind of studied and grew to become the CFO at Google. So obviously did very well for himself. And he's been my mentor for the last almost 7 years. And some of the things that really stuck with me that Patrick taught me over time was, one, when in doubt, be generous. And then two, life is long and the world is small, right? So I think, again, my kind of tongue in cheek saying this is very Canadian of just wanting to do the right thing. But I've just realized that doing stuff to help people, which, in VC, there's a lot of that to be done. And without expecting anything ever, but ultimately just seeing how it actually might pay off tenfold further down the road without, having invested in that has been really powerful. And so I just really invest in what we call serendipity now, right? Like just doing the right thing, and at some point it'll come back.
Venture's the hippie parts of private equity, as I say.
Yeah.
And we do
that's what my PE friends tell me as well.
Yeah. Well, we're also pioneering self-work retreats where we do yoga and shit. So
yeah, exactly.
So yes, that's very
we
much.
deserve the title.
Yes, and we're doing everything we can to live up to it.
Yeah.
Let's rush into your three biggest learnings in venture. You're a young guy, but you've made some realizations already. So let's get into them.
Yeah. So quickly, as I said, Inovia is the biggest firm in Canada, right? So ultimately, a lot of stuff comes to us just directly. And so for me, what I learned early on when I moved to Europe was I just need to get out there, right? It's not going to be about inbound because we don't have a brand. The brand was Patrick and myself. I do think we have a valuable kind of offering to founders, but whereas I was expecting or hoping a lot of inbound and I could just sit there and kind of get all the best deals, ultimately I just learned that I need to hustle. And it's something that I'd say I had a bit of an ego at first, and kind of getting turned down, be it by founders or LPs, was just like, oh, really? And then especially, again, working at a big Canadian pension where you have all the money in the world. And then I just learned that it doesn't really matter. And if anything, I enjoy the hustle of it, right? And kind of going out there, and ultimately that also just came with believing that, hey, what we're bringing to these people is valuable, so you should hear it, right? Like it's kind of going out there and preaching that we should speak. And so, yeah, kind of letting go of the ego, getting out there, just trying to get in front of people was just a really fun journey that, I enjoy a lot now. I guess the other one, coming from a private equity background, I was very, almost like, financial modeling and spreadsheets and this and that. But I've learned that it's only going to ever take you so far, right? And I've been super lucky to be mentored by Patrick. At Google, he grew it from, I think he joined at 20 billion in revenue and scaled it to 75 billion. And so there's only so many people that have that kind of experience. And for the record, he was also on the board when Twitter was bought by Elon Musk, and so has a lot of interesting stories. But yeah, so I've learned with him that ultimately, like I needed to take my P hat off, and KPIs matters and all that kind of stuff. Financial metrics matter, right? But ultimately, spreadsheets are really only like a 2D representation of a 3D reality, right? Like there's people behind the numbers, and like understanding what those numbers mean in terms of operations, in terms of where people are coming in, where they're spending their time, has made the job a lot more fun for me. And I think has been more enjoyable for founders also in the conversations that we have, right? Because they see that I care about the business. And I guess the last one, which is just very specific or quite specific to this environment, is really the importance of optionality and kind of thinking about what's the path to liquidity. And liquidity, it doesn't mean necessarily exit, right? Even for the founders. But I came into VC being like, oh, my parents are entrepreneurs. We should just be super entrepreneur friendly and we're investor forever and we're always going to be there. But the reality is, one, there's always a bigger fish, right? So we have LPs who we have fiduciary duties to when we need to return capital, especially if we want them to, to give capital back to us in our next funds and everything. I'm personally feeling that also. I'm an LP in Inovia and across quite a few funds, and capital calls are starting to add up. And so I'm like, okay, at some point we need to return capital, right? That's just the kind of circle of life of VC, if you will. But equally, I think it doesn't have to mean abandoning the founders either, or forcing decisions that feel unnatural, right? Like there's a growing secondary market out there that can allow VCs to kind of exit relatively gracefully. There's also continuation vehicles. There's all sorts of different strategies. And even an IPO doesn't mean we have to sell, right? We IPO'd Lightspeed in early 2019 and we're still shareholders today. And so to us, it's really about thinking, how do we align all the stakeholders? And quite often that's going to mean liquidity for the investors further down the road.
Yeah, and that is definitely something that we are all learning in Manture. Yeah, let's rush on to your strongly held belief that you've had to change your mind on. This one had you struggling a bit when I asked you.
Yeah, it did. I don't know. I went more of a philosophical route or something about well-being, and it's something that I've just been thinking a lot about over the last year because we're a small team in Europe, right? It's almost like a mini startup, right? It's entrepreneurial in terms of launching a new country and building all these processes and everything. So as people would know, when you're in VC and even more so when you're in a startup, it's always about prioritization and where do you spend your time. And for me, the saying goes like, time is your most valuable resource. I've just realized, yes, but headspace is even more valuable, right? Because you might have time, but if your time is spent thinking about what you need to be doing or listening to something and whatnot, and you kind of lose that time to think, that's where I think you start to feel overwhelmed. And so for me, it's just been really a realization of I need to protect my headspace. And I used to have this behavior of always, if I'm walking or if I'm going something or if I have downtime, to always like listen to music, an audiobook, a podcast, and nothing against podcasts because people should listen to this and others. But I've found that creating my quiet time, really just to think and like be on the tube and don't listen to music, for example, is actually really nice and really valuable for just my own mental well-being.
That's very true. As I said earlier, we're doing these self-retreats or self-work retreats. And one of my realizations was, wait a second. Now I know why my wife has been saying, you're here, but you're not here, honey.
Exactly.
I realized, wait a second.
Exactly. That's headspace, right?
Yeah, because I was bitching to her about me not putting in as many hours as I have before in my life now that we have kids, and one of them requiring more time than what one might have planned for.
Yeah.
And then I'm like, I'm here all the time, man. And now I realize, okay, wait a second, maybe I wasn't. So some grounding techniques, some things that allow us to be where we are fully present, I think
exactly.
Very important for all of us to get into.
Yeah, a good saying for anyone is this guy said, in the moment you can say these are the good old days, and the thinking just being you're going to look back on today being like these were the good old days, right? But you're living the good old days every day. And so just to ground yourself in being, okay, I'm with my wife and my children, right? These are going to be the good old days eventually. So just make sure you appreciate them in the moment.
Yeah, that's very, very true. Something we all struggle to make sure that we live by, because it's so easy to get caught up. Speaking of getting caught up, let's move on to top tips for VCs fundraising.
An easy one, right? Start yesterday. So, VC relationships or LP relationships take years to build, and that's on both sides, right? Like you want LPs that are going to be supportive, that are going to be there for the long term. So you don't want just like a quick check and a goodbye in a lot of instances. And the other thing that's important, again, for very tactically for the people that are going out there to build relationships, this year for us as part of the European fundraising strategy, we said, okay, let's try to go to conferences and see how valuable they are. And very quickly we learned like you need to prepare for conferences months in advance, right? Like there's one I started reaching out 2 months in advance, and like LPs would tell me, oh, sorry, my schedule is already full. And some people already had time and whatnot, but just like the amount of outreach that they get. And I speak to my LP friends and they tell me the same thing, right? It's just like a tsunami of outreach. And so start long in advance and make sure that you also kind of customize your email and saying, here's why I think I'm actually valuable for you, because you want to do the homework for them almost in a way.
Yeah, you definitely have to. And then on top of it, the LPs that actually go to VC conferences or tech conferences are far and in between, and they're heavily shared between VCs.
Yeah.
So it's like they are coveted.
I've seen the trick that they do usually. You know it's an LP if they seem to have done it, like to turn their little like lanyard
Yeah.
so that you can't see their name or the LP tag. That's probably an LP because they just get kind of swarmed if they show it. So that I've learned that this is a technique used by many.
Yeah, and it is very true. Yes.
Yeah.
All right, know your LPs well is your second advice.
Yeah, I mean, again, it's just about saying, am I relevant to you, or am I like personally even spending the right amount of time on the right relationships? And for us, there's also the extra layer of, because we have a North American strategy, what we didn't realize early on is that we talked to some European teams, but that had US counterparts. And so we invest a lot of energy in kind of, okay, like these people are great people, we get along, they get the story and whatnot. But then when it's actually kind of game day and they need to make a decision on Inovia, we realize that because we're 2/3 North America, we fall into their North American bucket. And so their colleagues in the US are the ones taking the decision. And then from a relationship perspective, we're back to square one, right? It's not ill intent, it's nothing bad, but it's something that we didn't spend enough time understanding their own processes, their own appetite, their own strategies, and that we're just back to square one in terms of that kind of pitching relationship. And they're going to say a good word, right? But it's still very different if you're pitching someone that's never met you before.
I would add to your sentence, not so that it's not know your LPs well, but know your potential LPs well.
Yeah.
Because it's that part of there's so many that could be LPs. There's not a lot that will be LPs. So it's really important for you as a VC fundraising that you try and, as quick as possible, figure out if this LP is actually a match for you. And you don't do that, just to correct some, because we've spoken a lot about this topic on the podcast. And it seems like maybe we've given the wrong advice, because there's a lot of VCs out there that then rush to understand the decision-making process and how do we move through this gate and who's in the IC and when do you have your next IC meeting? When can we expect XYZ?
Yeah.
Like, you don't ask those questions first date.
No.
You try and figure out who they are first and what they're interested in. And then at some point it makes sense to talk process and make sure that you are aligning your process with theirs. But to begin with, you don't want to ask those questions.
It's like asking about marriage or children on the first date, right? Like I mean, I haven't dated in a while, but like it feels a bit premature.
Yeah. I described it in another podcast less nicely, because I described it as talking about which position during intercourse you prefer.
I went the PG-13 route, but kind of same analogy.
Thank you for saving that. Well, I blew it anyway. Finally. Yeah. So speaking of intercourse, your third and final advice is do the work for them.
Yeah, exactly. There you go. Perfect segue. I won't even go deeper on the analogy there, but from a fundraising perspective, and again, that's from, my time when I was an LP, my time fundraising, but also just the conversations I have with other LP friends of mine. They get so much noise in their ecosystem that it needs to be very straightforward for them to be able to make a decision, right? So the art that we were talking about in terms of how do you close an LP and how do you kind of herd them towards something. If, for example, I mean, if all your funds are 10x and kind of super strong DPI and whatnot, like that's going to be relatively straightforward. If you're not there yet, right? Because it takes time to get there, be it fund 1, 2, 3 and whatnot. Just make sure you make it as easily digestible as possible for them. So the example of the Canadian deck that I did for this Canadian pension to educate them. Other examples could be if you have kind of good returns on paper, but you obviously the fund is still maturing, and just like actually charting the path to like, okay, here's how the fund is going to be a 4 or 5x. Here's the companies that are actually mostly driving it and whatnot, and making it really easy for them to actually arrive to the conclusions you want them to arrive to. It's definitely worth your time. Like, don't think that they're going to do it on their own because they just don't have the time for it.
Yeah, couldn't be more in agreement. Mike, thank you so much for coming on the podcast. I'm so happy that we got to know each other.
Yeah, likewise. This was a lot of fun. Thanks for having me.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.